Hey everyone, the stock market has been an absolute free fall in the last month or so. So I just want to jump on, make a video about how some of the exchanges have been impacted over the last month from taking a step back here, looking at a bigger picture, also looking at some of the drivers of what's going on in the economy before looking at some of my stocks that are down the most and some other stocks in the market that are down pretty big as well. So we'll start here just with the Canadian top 60 stocks in the Canadian Stock Exchange, down about 7.5% here over the last month. A huge downward number for a 1 month span. But it's not just the Canadian markets here. We also see the NASDAQ down 7% in the US, and the Dow Jones also down about 5%. These are some of the most resilient, largest companies in the world, down 5% on their value in the last month in aggregate. So in the year to date, actually, the Dow Jones has actually slipped in the negative territory for the first time since much earlier on in the year. So a lot of downward pressure in the market right now. Looking at my portfolio specifically at a high level before getting into what looks like is going on, you can kind of see here my Canadian portfolio alone. I'm down almost $10,000 just on the Canadian side of my portfolio in the last month. In the last week here, if we let it load, down almost 5,000 bucks in a week. Going over to the US side, down 1,200 US dollars on the week and down about 4,000 US dollars on the month. So in Canadian dollars, between the 4,000 US lost and the 9,200 Canadian loss, I'm down about $15,000 in this account just in the last month, which is crazy to see. Pretty much all the gains I've had in this account in the last 18 months or 24 months or so, essentially completely wiped out by the market over the last month. So what's going on? As we look at some of the main drivers of what's going on in the market right now, one of the biggest things is interest rates. So you can kind of see here the 10-year Treasury yield actually just rose to the highest level since 2007. You can kind of see here what that looks like, up to 4.8%. And we're really used to these numbers, 2.2, 2.3, all the way down to under 1% during 2020 and whatnot. So to see it go all the way up here to 4.8%, which is continual upwards pressure, really goes to show how the market does not believe that interest rates are going down anytime soon, and if anything, it increasingly looks like there are some concerns that they may be rising more. Some other comments here that were made that I just want to outline as well was around just the fundamentals here. So lots of the fundamentals in the market actually still hold pretty strong. I agree with that statement. Just if you're looking at things company by company, the valuations have gotten much cheaper. They're still producing strong free cash flows. The multiples have just gotten significantly lower on fear that interest rates are going up. But there is a lot of concern just at a macro level of these interest rate increases. And at some point, it's just going to break things to a huge extent. Going from 2% interest rates on mortgages to 5%, which is kind of where we are now, give or take, are one thing. But when we're out looking to new homeowners, maybe needing to pay 7%, 8%, when people who have credit card debt and lines of credit are going from 2 or 3% interest rates up to 10%, these are huge pressures being put on the consumers, specifically in the US and in Canada here. And I think in addition to just the opportunity cost of where you can be putting your money, getting a 6% return for no risk essentially in government bonds and whatnot. That provides a strong opportunity cost from stocks. But the other side of that coin, that is another headwind for stocks, is just in addition to the pressures that this puts on operations of companies, now instead of paying 2% on debt, REITs have to be paying 5%, 6%, 7%, 8%, puts a lot of pressures on cash flows, profitability. And in addition to that, it's putting a lot of pressure on consumers. At the end of the day, the whole economy relies on consumers buying products, services. So as consumers have to now pay higher interest rates, as consumers may face increasing layoffs from companies depending on how their operating profits are and whatnot. That puts a lot of strain on the economy. So it's a combination of consumer impact, operating impact from servicing debt levels, as well as opportunity cost in the market from investors being able to just get these risk-free 6-7% returns instead of hoping that a stock goes up 10%, where it may go down 10% or 20%. You can park money in risk-free assets that are providing you pretty good cash flow right now. So that's my take on what's really going on in the market in terms of how interest rates are having this kind of impact in a huge way in the market, which we just went through $15,000 down in my portfolio. Going through some of the stocks in my portfolio that have been disproportionately hit, it really goes down to the stocks that really, have a lot of debt on their balance sheet and just have debt as a core part of their business and operating model, which we'll talk about here in a second. B, have extremely high percentage of their revenues coming from consumer discretionary offerings and products. Or C, companies that operate in or kind of trade in like bond-like type assets as well have been hit really hard. So we're going to go through some of these stocks today that I've just been getting killed on over the last month. We'll start here with Allied Properties. Now this one I always thought like at some point there must be a floor to it. That's why I was buying more of it in the 20s, just nibbling on it. But it seems like it has just blown by this floor. Currently trading down 18% on the month, $17 a share. This stock, just for background, makes about $2.20 of funds from operations a year. So trading at like a 6 to 7 times earnings here, like a seven to 8 times earnings here, if the math on top of my head is right. Pays over a 10% dividend at these levels. Has a net asset value. What would you guess? Just think in your head, take a minute. What is the underlying real estate of Allied Properties worth if you take the value minus the debt of the company? Is it 25? Is it 30? Is it 35, which would have it trading at a 50% discount? No. Last quarter, it was actually audited at $57 a share. Or $55 to $57. I may be mixing up REITs here. So it's trading about 70% discount of fair value right now with how much it's gone down in the last month. I'm currently down 36% on this one, so I've just been getting killed. But it's not just Allied. We look at across the REIT space, the entire REIT sector is getting hammered. We look at RioCan, which is a retail REIT, so less office exposure. If we look at RioCan in the last month, bam, down 12% in the last month on this one. Another stock I own is CAPREIT. CAPREIT over the last month is down 11.5% as well. CAPREIT is a residential REIT. They don't have much occupancy risk. They have a lot of secular tailwinds with new Canadians coming into the country, foreign students, just general shortage of housing supply. Yet the stock still goes down 12% despite these fundamentals because of the fact that their business model inherently involves high amounts of leverage when we're talking about real estate. Going back a bit here to my portfolio, some other stocks that have just been getting hit hard are my utility companies. So Fortis here. Fortis down 5% on the month for a company that's usually really stable, but they do have a lot of debt. They do trade like a bond-like asset. They are getting kind of caught up in this. Canadian Utilities, another one similar to Fortis, down 12% in the last month. This one here has actually been a dividend king, increased their dividend for 50 plus years. That dividend's currently at 6.3% here. So really strong starting yield this one's been priced down into, given investors' lack of appetite to hold these assets that have a lot of debt on their balance sheet. Looking at other companies that trade kind of like bond alternatives, royalty funds have gotten absolutely hammered. You have the KEG royalty here, and in addition to just kind of trading like a bond alternative, they also rely on some level of discretionary spending, being a higher end sit-down restaurant. So as we go through some of these stocks, it's companies that have high levels of debt, companies that rely on discretionary income, and companies that trade like bond-like assets. The more check marks that a company checks off out of those three, the higher likelihood that their stock's going to be down huge over the last month. So KEG Royalty doesn't have a lot of debt because of the nature of their business. They don't actually hold debt really, but 2 out of 3 check marks. They do rely on discretionary spending. They do trade like a bond-like alternative. bam, down 14% in a single month. Continuing to go down here, some of these other stocks like Rogers, high debt load, as well as trades like a bond-like alternative as well. In the last week, down 6% here. In the last month, down 9%. This is one of the largest blue chip Canadian dividend-paying stocks, but because it relies on debt, because it trades almost like a bond-like security in lots of ways, down 9% in the month, getting almost a 4% starting dividend yield on this one. It's actually probably the highest I remember seeing Rogers in recent history. So when you kind of unpack everything, some really interesting buying opportunities, in my opinion, for the long term. It's one thing buying a company like Allied Properties, which has some risk ahead of it and some uncertainties in terms of occupancy rates, people's return to office, downtown demand for office real estate in general, if they'll be able to refinance their debt, at what rates they'll be able to refinance. It's so many questions going on companies like this that despite my being a bit perplexed on how far it's gone down, I'm not necessarily surprised by the selling pressure. But then there's blue chip companies, really stable business models, like Rogers that I was talking about. And I haven't been buying Rogers because I'm waiting for them to kind of fully digest Shaw. But at some point, it gets really interesting when you have these blue chip Canadian dividend paying stocks yielding 4%, holding really strong assets like the largest wireless business in the country, sports assets like the Toronto Blue Jays and a percentage of MLSC, et cetera, trading at 52-week lows and multi-year lows, actually, when we look at a company like Rogers here, with the exception, actually, they've even gone past the 2022 lows when they were having some of those issues. So yeah, this one's down from over $70 a share down to $50 a share for what you would have thought would be a pretty stable company here. Going into the US side of my portfolio, similar theme here. You have big tech, which has actually held up pretty well here. So we have Google as an example, down 2% in the last month. Talking about Google a bit, the benefits of big tech like Google, like Microsoft and Meta to some degree, is they do not have much debt on their balance sheet given like relative to the amount of cash they have. And with their $100-200 billion of cash, they can actually start earning a lot more interest on a monthly and annual basis because they're the ones who have the cash. And right now, cash is king in the stock market. They also have extremely strong free cash flow. So it's not like they're losing money or relying on their free cash flow or their CapEx, their free cash flow to fund their CapEx initiatives. These companies are swimming in money right now, and they'll continue to probably do well no matter what happens in the short term with the market. So they haven't really seen too big of a hit, which has been one bright spot in my portfolio. But continuing down on some of my other stocks here, Realty Income, similar story as Allied and RioCan, down 13% in the last month, relies on a business model that includes inherent high levels of debt. So same story there, but this one is now yielding over 6% for one of the best quality REITs in the world. So that's a really interesting opportunity. Continuing to go down, AT&T, super high debt load on this one. A bit more questions than Rogers on their actual business fundamentals, I guess you could say. But overall, this one in the last week here actually has held up much better than I thought it would. About flat, I was expecting this one to be down, looking a bit longer term, down over the 3 months. But I'll give them credit for holding flat through everything over the last month. Maybe something else positive went on there to offset it. So that was interesting. And then generally, whenever the U.S. economy and interest rates begin to have issues, it really floods into more sensitive economies as well. So like emerging markets and whatnot. So when we look at the Vanguard Total International ETF, stocks down 7% in the last month just on fears that all of these things are going to lead to a global recession. And lots of companies, lots of stocks in the US, as we talk about big tech stocks and other really strong companies, they'll get through it. They'll get through almost whatever the economy throws at them. But there's lots of these stocks in smaller markets that are hanging on by threads and don't have huge cash hoards, don't have as much government support. So we really see a lot more anxiousness in those markets, and that's what's leading this fund down about 7%. On this one, you can kind of see here, even though I've been averaging down, still down on this one, just given my timing, which I don't mind because it's still an early position for me. So just taking a look at some other examples in the market that have just gotten crushed here with the broader stock market. We got Enbridge here down 10% in the last month alone. Enbridge is a $100 billion energy juggernaut that just lost 10% of its value in the last month on interest rate speculation. Okay, so when you're starting to evaluate some of the opportunities out there in the market, and it really depends what you wanted to invest in the first place, but I truly believe there are lots of potential opportunities unraveling in the market here. We got Brookfield Infrastructure Corp. This company owns infrastructure assets all over the world, telecom cables, shipping assets, toll roads, etc. Down over 10% in the last month here. Vici, obviously or for those of you who don't know, owner of lots of gaming assets in the US, think lots of assets on the Las Vegas Strip. They own golf courses, etc. Down 9% here in the last month, despite being a triple net lease, getting paid the first of the month no matter what's going on. But they, similar to the other REITs, have debt as a inherent part of their business model. And investors right now are just trading down anything that has high exposure to debt, just given the uncertainties on where rates are going, how long they'll stay there, etc. Investors don't want any of it. RioCan we looked at quick, so we won't really jump into that one as well here. But Realty Income, talked about it too, 11.5% down here. This one makes about $4 of FFO a year, so trading at 12 times right now on Realty Income for a company who has assets in every state, triple net lease, really well diversified, some of the best tenant mix out of any REIT you will find out there. And that's tons of scales, tons of synergy opportunity to drive funds from operation forward. Some other stocks that have really gotten hit here are companies with really high earnings multiples. And that's just because when interest rates go up, the opportunity cost of waiting for future earnings also goes up. When you can be making 6%, 7% on cash today, to wait 4, 5, 10 years for Shopify to drive a 7% free cash flow yield, that begins to become more and more painful. And you can start using that 7% in annual income today to start averaging into some of these names long term with your interest and still have all your protected capital. So lots of people start looking at those kinds of opportunities, those kinds of strategies, and stocks like Shopify that trade at an enormous earnings multiple versus what EPS they deliver today get traded down in a big way. So you see here Shopify down 20% in the last month. Amazon has a couple other things going on with the stock, but even after all that got digested, down another 4% here today. Tesla down as well here today, down 2% today. Over the last month, actually held up decent, but still down 4%. Topgolf, this is a great example of a company that just has a lot of exposure to discretionary consumers. Consumers don't need to go to Topgolf. It's a lot of fun, and when the economy is booming and in that cyclical rush, this company can explode and do phenomenally well. But they're currently expanding their CapEx spend and taking on more debt over the last few years at a terrible time, macro speaking, with interest rates going up, their cost of serving that debt's going up. They don't really have the free cash flow they're making from operations because they're investing so much into building out new Topgolf locations that may or may not be as successful as recent ones just because of the current state of the economy. So while a great long-term business here, they're moving and pushing very aggressively in a time that the market and investors almost prefer a conservative approach that's preserving capital, not overspending free cash flows, managing debt appropriately. So long-term, as long as they manage this well and they don't continue to build more and more debt that they're unable to service at the same time that demand may be going down, equity holders should hopefully be okay if they can kind of manage this teeter-totter appropriately. But that's kind of where some of the risks come into these names and why some of them are trading down to these extent, because this is essentially a bet that the economy doesn't go down too bad and they're able to continue to drive free cash flow from operations and continue to have that free cash flow cover that CapEx spend that they've already committed to. Because if not, they have to take on more debt or dilute shareholders, both of which will have a lot of downwards pressure on the stock here today. Airbnb, another one here right in that consumer discretionary side of it. All of travel right now is getting absolutely hammered just because of consumers potentially not having the same amount of funds or appetite to quote unquote revenge travel like they have over the last few years. So we see Airbnb down 10% right now. We see Carnival Cruise Line down 17% in the last month. We see Wyndham Hotels here, which is a more traditional, conventional royalty hotel network, down 12% in the last month as well. So, travel's down double digits. For anyone who may have been wanting to get into some of these stocks for the long term, this could be a good opportunity. I'm not saying it is. I personally don't believe I own any necessarily pure play travel stock. I do own Disney, unfortunately, over the last number of years. But I've been in and out of Airbnb before. I've been in and out of Wyndham before. I've never really been in CCL in a big way. So these are potential opportunities here for someone who may want to build out a travel side of their portfolio, buying on this 10% plus correction in the market. Maybe it goes down another 10%. I don't know. But it's just really interesting to see some of these really big blue chip juggernauts trading at these multiples that we haven't really seen over the last few years as the markets really ran up. And they bring opportunities to potentially add names to your portfolio, high quality names in lots of these companies at valuations that you can swallow that maybe you otherwise could have. Obviously, you're also managing the opportunity cost of, hey, do I really want to buy Brookfield Infrastructure here at whatever, 12, 13 times funds from operations at $45 a share, when I could just be getting that same free cash flow yield by putting this money in a GIC. And that's where it really comes to you in terms of what your risk reward appetite is. Do you want to just be a bit more conservative, hold that money on the side and watch things play out? Will you be able to live with the fact that Brookfield Infrastructure may skyrocket up to $65 in the next 6 months, and then you wasted the opportunity to get a 30, 35% return because you wanted to be safe with the 5, 6% return? On the other side of the coin, if you invest in Brookfield, are you okay with Brookfield going down 10, 15% more if the consumer continues to weaken, if interest rate outlooks continue to go up, instead of just taking that guaranteed 5 or 6%? So those are kind of the balances you need to decide in your portfolio and how you manage your assets. Maybe you do a bit of both. Maybe you go all in on one side. But I just thought, I wanted to jump on today and make a video just because I saw all these drastic, huge moves going on across the market. I saw my personal portfolio on Wealthsimple alone swing $15,000 in the last month. So thought lots of you guys may be having some similar thoughts, looking at similar traits in lots of these companies, and wanted to just talk my thoughts out with you guys as well. So hope you guys like this video. If you did, be sure to give this video a big thumbs up. And if you're new to the channel, be sure to subscribe to the channel. We're trying to grow the channel as fast as possible, so we'd really appreciate that. Thank you guys so much for watching, and I'll see you guys in the next one.